Welcome to the ETF Show, taped here at the Asset TV studios in New York. I'm your host, Kristen Myers, ETF Editor-in-Chief for Asset TV. Now, the U.S.-Iran war has now dragged on for 2 weeks, sending oil prices surging and markets into a tailspin. But even as the Iran war tests investors, markets historically have been proven to remain remarkably resilient in the face of geopolitical crisis. So listen to this. Since the Cuban Missile Crisis in 1962, markets have risen on average about 0.4 of a percentage point in the 1 month after a major geopolitical conflict, like the Iraq War, 9/11, and the Syrian War, and more. Now, 3 months after a crisis, the S&P 500 has historically risen on average just under 1.5%. And it seems like this time might be no different. So joining us now to discuss is Simeon Hyman, Global Investment Strategist at ProShares. Simeon, thank you so much for joining me today.
Thanks for having me.
So you wrote a recent note where you mentioned, and I'm going to quote you here, that stocks, while initially battered by conflict-led uncertainty, recovered relatively quickly. Now, it does seem that equities are remaining fairly resilient. How are you interpreting the market reaction so far?
Well, look, it's muted, and that's for a couple of reasons. But first, let's go back to your history for a minute, because I just wanted to give a little more detail. Because if you focus in on the Gulf stuff, you get the same story. So we know last year in the 12-day war, markets rebounded all the way through the end of the year. But even in a more protracted Gulf War 1 and 2, which were not done so quickly, the markets were up, 30% by 12 to 18 months later. So markets have been resilient subsequent to conflicts. It's sometimes tough to stay in your seat while the humanitarian crisis is going on and when the bullets are flying. But with respect to what's going on currently, we have good fundamentals. Earnings growth last quarter was pretty good, low teens for the S&P 500. Inflation's been okay. Now, we know that higher oil prices might change that over the next couple of quarters, but the last couple of readings were pretty good. The economic soft landing seems to be in hand, and I think that's been an offset to the conflict in many ways.
And I am going to get to all of that, because you touched on all of this in this great note that you wrote recently. I'm curious to know, because one of the major themes that you really highlighted in your analysis was really the broadening of the market participation beyond, mega cap tech. So what do you think is really driving some of that rotation that we're seeing right now? Why do you think maybe that it has staying power?
Some of the broadening is just a price reaction. Stocks that were left perhaps too far behind in the mega cap run of the last several years. But some of it has very strong fundamental underpinnings. One of the signposts that we look for is, when are those quality stocks coming back into the conversation as part of this broadening? Our favorite is the S&P 500 Dividend Aristocrats. We track it in our ETF Noble. Now, let me do a little fundamental thing here. Bear with me.
Yes.
I'm going to go back to Q1 2025. NASDAQ 100 earnings grow over 30% year over year. S&P 500 earnings grow about 10 or 12%. Noble, the S&P 500 Dividend Aristocrats, with this great run of at least to be in the club, you have to grow your dividend 25 straight years. In Q1, their earnings shrank just a smidgen. So the fundamentals had a gap. Fast forward to Q4. NASDAQ 100 earnings are up low teens. S&P 500 earnings are up low teens. And the S&P 500 Dividend Aristocrat earnings are now up 10% year over year, almost completely filling in that gap. That's a fundamental broadening that's at least as important in terms of the durability of the broadening that we've started to see in the equity markets.
So you're obviously mentioning right now, again, why, that dividend growth strategy is so compelling, right now, just looking back at some of that data and the fundamentals. But I'm curious, if that market leadership is broadening, what does that mean for those ETF investors that have been so heavily concentrated towards some of that mega cap tech names? Because a lot of people have not wanted to bet on tech. Bet against tech, I should say.
So let's go back to my little example. The S&P 500 earnings were steady. The leadership changed and got more balance, but the S&P 500 earnings were steady. What that suggests to us is there's a real opportunity. Again, we got to get through this conflict, but we know the history is markets do well through that. But if you think about the steadiness of those S&P 500 earnings, and even the NASDAQ 100 earnings that haven't plummeted, they're just not 30% year over year, it very well may be a soft landing for those mega cap tech companies. In other words, the S&P 500 dividend aristocrats, Noble, can outperform without the type of tech correction that we saw in 2000, because it may very well be a soft landing for the leadership of the last several years of the equity market.
Do you think markets are pricing in that soft landing in the economy?
They're certainly not pricing in any sort of disaster. So we can't, there's no way that you could parse markets overall as being cheap. But you can point to sectors and areas of the markets that haven't kept up with mega cap that are particularly attractive. Noble's trading at a discount to the market PE. Because of its quality, historically it's traded at a premium. That's on sale. Now there's a lot of things on sale, but you got to be careful because some things are on sale for a reason. Right. And one of the things we've noted is, if you just take as an example the equally weighted S&P 500, everybody wants to talk about that. Right. If you equal weight the S&P 500, sure, it's cheaper, but you actually degrade the quality. But with the S&P 500 dividend aristocrats, that's an equally weighted bunch of quality stocks that have better fundamentals. As an example, stronger return on assets than the S&P 500 without the Mag 7. That's pretty cool. So there's a lot of stuff that is relatively cheap, but you want those fundamentals supporting it for a durable opportunity.
So in your note, again, you had warned, right, against investing based on, the boosted fundamentals, and you called it, or you said it was essentially analogous to chasing the benefits or short-term sentiment. So I'm curious how a lot of investors, and ETF investors particularly, can really distinguish between the temporary, market sentiment to the upside, or the momentum to the upside, from a more sustainable investment.
I really do think that it's focusing on quality. I was just looking at a screen on that terminal thing. I'm glad you guys had one in the waiting room. Oil stocks are only up a smidgen, not tracking oil, not tracking the meteoric immediate bump in oil prices. And even that GICS aerospace defense sector, it's actually down a little bit since the beginning of the war. So you think you have the trade, but that's what it is. It's a trade. And even if you're looking at a near-term boost in profitability, if it's not a sustainable one, it's not any more enduring than any other trading idea that you might have based on the news of the day. So I think it comes back to those fundamentals. Who's got the persistent cash flow? Who's got the return on assets? And who's paying consistent dividends, which is demonstrating that.
So you're talking about the equal weight. And I want to kind of circle back to that, because there has been some suggestion that the equal weight indices or the broader market exposure could benefit from some of this market rotation. So how should investors really be thinking about diversification? That's been the very big word, it feels like, for 2025 into 2026.
So I mentioned that equal weight, from our perspective, if you're just talking about the S&P 500, is sort of not enough because it's indiscriminate. And that's why we like quality approaches like dividend growth. But in terms of being diversified, if you're thinking about mitigating the weight of the top market cap players in the S&P 500, why would you just stop at trying to diminish their weight in the S&P 500? This is as important time as any to make sure that you have mid and small cap exposure. I mean, mid and small cap stocks, even their little bit of a rebound last year, barely dented the nearly historic valuation discount. There are a lot of ways to play that. It would not surprise you that we have dividend growers in mid cap and small cap. So REGL is our mid cap dividend grower, the S&P 400 dividend aristocrats, and SMDV is the Russell 2000 dividend growers. But look, we like our dividend growth mid and small caps, but folks should be looking at any opportunity to make sure that they have mid and small cap exposure. You got it right. If you don't have it, you're happy you didn't have it for the last decade or so. But if there was ever time to make sure that you had that element of diversification, now is the time.
All right, Simeon Hyman, Global Investment Strategist for ProShares. Thank you so much for joining us. Thank you for tuning in to the ETF Show at Asset TV.